Clinton Okhai. Is that how you pronounce your surname?
But it's actually Okhai because I'm from Edo State in Nigeria, and so in my language, K is silent.
Clinton Okhai is a growth and capital architect. He studies why deals die and what investors discover during diligence. He helps founders close the gap between fundable and investable businesses. So thank you for agreeing to join us today. You created a post which made me sit up and think, and I thought that everyone who's trying to go for funding, whether it's from VCs or angel funders, they should really look at this and consider whether they've passed this test. So tell us about yourself. Tell us about what you're doing right now, Clinton.
Well, just like you rightfully said, I'm a growth and capital architect. So what that means is that I help startups to grow, to scale their businesses as regards everything that has to do with brand, sales, marketing, distribution. But most importantly, I help them with fundraising strategies. Not just fundraising strategies, mainly helping them do all that is needed for them to become investable. Because you see, many startups, especially in this region, in Africa, and then let's say the MENA regions and all over the global south, they are not particularly investable. And so it was a gap I saw in the market. And then, let me give you this backstory of how that happened. So initially, as a growth marketer, so a growth hacker working with a lot of startups, and then it was really cool, and I was really helping startups to hack distribution, get a lot of traction and all that, and then the founders I worked with, they started getting interested in raising outside capital to scale the business faster, typical, and so working with them, trying to see how we could raise capital. I began to see that many of these startups, they were not raising funds. So when they reached out to investors, tried to pitch their business, they were getting a lot of no's. And then it was more or less like a dilemma for me because I honestly always thought that a startup just needed to have some traction, a little bit of traction, good numbers, and then investors would say, yes, oh, this is a good business to invest in. But that wasn't the case. And then that took me down the path of trying to understand what makes a startup investable, what will make investors take out money and say no to a lot of other people and give you the money because they believe that it's going to bring back returns for them. So I decided to do a lot of digging, learning a lot, trying to help these founders I worked with. And then I began to see patterns and then saying that, the reason was because structurally, as regards governance, as regards compliance, as regards your cap table, your financials, and then the team structure. In fact, how the startup is placed in the market that they are playing in, and also the founders. These things are all work together to make a startup not seem too risky. Because the truth is that every business is risky. And then investors choose to invest in businesses that are not so uncertain, that they believe that when they invest capital, either the business itself is going to bring back returns, or the founders, they're going to find a way to do something new, and either they pivot and then they're able to get something doing that brings back money for these investors. And so after doing a couple of diggings, working with a few people, I decided to start a company, and then it's called Mathetes Capital. So I got that from the Greek word. Mathetes is a Greek word, so it simply means to disciple. I realized that many of these startups needed a little bit more discipline as regards structure and all these other things I just mentioned about. And then I and one of my colleagues, we started together, and then it's really been cool. It's been a whole lot of journey. It wasn't funny when I started, right? I was really excited and all that. But going down the path more, I began to discover a lot more things, working with a lot more founders, and then also having to talk with a lot more founders, that investors, and having mentors that are helped me down the journey so far. So it's been amazing, to be honest.
Now, what I'm going to do, I'm going to share the screen and show people what it is that you posted on LinkedIn. So if you could just talk us through, it's got 7 reasons VCs and angels will not invest in your startup this year. After months of speaking with VCs, angels, and family offices and founders, I've noticed something uncomfortable. Most startups do not get rejected because they're bad. They get rejected. So I'm going to go down. You've got 7 numbered points. And if you could just talk us through each of those points, please.
All right. So I'll try and do that. So the very first point here is that you cannot explain how investors make money, which is very typical. So a lot of founders tend to focus on the pitch of how beautiful the idea is. They focus more on storytelling, on why they started this company in the first place, how it's going to be of so much impact in the society. But this is not what founders care about. Investors don't really care about that. Well, grants bodies, yes, they do. But when it comes to institutional investors like venture capitalists, they don't really care about that. They care about return on investment. So if you cannot explain how, when they give you money, let's say they give you $250,000, 500K, or $1 million, you cannot explain how that's going to turn out into $10 million or $5 million or even $2 million, right? They're not interested because you see, these guys have worked with a lot of startups, put a lot of money and lost a lot of money. And many a time they get to break even. Just a few of the startups they invest in get to bring back the returns that they were promised, right? So many startup founders do not know, they don't have a clear pathway of how the business is going to make money, become more profitable, and give these venture capitalists their return on investment. So number 2, your traction doesn't look repeatable, right? Yeah, your traction doesn't look repeatable. So 1 customer proves interest, 10 customers prove effort. So let me start again. So when you have 1 customer, right, it proves that people are interested in your products. When you have 10 customers, right, it proves effort, right? But a repeatable acquisition system proves a business. Investors fund businesses. They don't fund ideas. They don't fund the fact that you have 3, 4, 5 people willing to pay you money. They want to see that you have been able to do this over and over and over again. It's repeatable, right? This is how we are going to scale from our current 50 customers to 100 to 500 to 1,000 because we have tried this particular strategy in the market. This is what is bringing back. This is how we are going to act network effects to ensure that we just keep multiplying our number of customers and money. All right. So number 3, nobody can verify your numbers, right? So due diligence is where many startups lose the deal because they do not have many of these things properly recorded. So a lot of startups have come to see when they start their businesses, they don't record their numbers well enough. The founders rather, do not know their numbers. So if you've watched many of these, let's say Lions Den, right, where investors are asking founders questions, they're asking for their numbers in the business. Oh, how much money did you make 2 years ago? How much money did you make last year? Oh, how much revenue have you had this year? You see, a lot of startup founders begin to stutter. They don't know their numbers. They begin to say, oh, I think it's this, I think it's that. You don't want to think it is this. You want to know exactly how you have come to this point. And if you have not been able to track your numbers, especially when it comes to financials, you're a bad business. Nobody's going to fund a bad business, right? And if you cannot verify every single thing you have put on your pitch deck, right, then you are lying. Nobody's going to fund a liar, right? So number 4, your cap table tells a worrying story. So what this means is that you started a business, maybe you had like a family member, a friend, give you some money. Let's say they gave you like $5,000, $1,000 to start up, right? So we call these family, friends, and fools. And then maybe along the way you get a mentor or an advisor on the board. Then you get like a few angel investors, and then when you're going for more institutional investors, they get to see that you have a lot of people in your cap table, right? So your cap table is just a more or less like a short form of the number of people that have equity in the business. If so many people have equity in your business at the beginning stage, that's bad business. Investors do not want to have to come and start fighting with equity with every other person, because it means that along the line there's going to be some legal battles. Nobody wants that. Nobody wants to invest in something that's going to cause a lot of trouble for them down the line. So number 5, you confuse activity with progress. Okay, this one is very funny, right? So you see, a lot of startup founders, they tend to think that they are entertainers, more or less like, yeah, a lot of people are creating content these days, but they think they are influencers. So they come out just talking, oh, I'm happy to announce we closed this partnership, or we're happy to announce our pilot programs, number of downloads, press coverage. This is not it. This is just activity, right? It's not about all these things that you come out and people clap for you on LinkedIn and say, oh, he's doing really well. No, you're not really doing well. What are you really getting in the back end? Are you moving from stage to stage? Is your revenue climbing? Are you growing month over month, right? Are you profitable? Have you broken even at some point? If you cannot really show that your business is profitable to investors, that even if you're not profitable yet, show a pathway towards profitability, they are not going to pay attention to you. So all that noise, all those drama doesn't move investors. And so number 6, you need capital to find the business model. All right. So I've met over, let's say, 15 founders these days. They've come to meet me talking about their amazing idea, or how their idea is going to like turn into like a unicorn in the next 3 years, right? All still idea stage. No business at all, no even demo, nothing to show that, oh, this thing is really working. Nothing to show that they've been able to like get a few customers down the pipeline, or they are looking for money to start a business. Well, there are some specific cases towards this. Let's say you are into deep tech, right? And then let's say things like space tech or hardware, right? But if you are really running in normal tech business, that is something that has to do with AI, something that has to do with maybe a SaaS and business model, you don't need money to start. AI has made everything really easy. You can quickly create an application. You can quickly get something running and then test it in the market to see if you're going to get users in the first place. If you need investors' money to create a product at this point in time, 2026, nobody's going to listen to you. Right. So lastly, the company depends entirely on you. So if you're a founder and then you're doing founder-led growth, and then yeah, you are the face of the company, you're the face of the brand, and then everything revolves around you like you're the sun. It's not bad when you're starting up, but along the while, you want to start delegating a lot of things to people, so that when you are not available to get some particular task done, the business can run by itself. You don't want to be the one running the business day in, day out for so long. I mean, when you start, it's okay. But along the line, you want to have people that are able to manage your business for you when you're not there, because you are going to start focusing on things like fundraising. You're going to start on things like maybe going for partnerships, traveling here and there when your staff is getting lots more accolades and all that, right? You need the business to keep running when you're not on seat. So that's basically it, the 7 reasons why you're not going to get funded by investors in 2026. So that's it.
Okay, that's great. That's wonderful. Thank you so much for that. Now, you were offering people who read this some kind of checklist, weren't you? So we'd like to offer that through you again through this video. Would you be interested in sending them that checklist if we give them a link at the bottom of the video?
Of course, anyone that's interested, they get it for free completely. It's a 47 point checklist that lets them see the various things that investors pay attention to decide when they are doing due diligence, when they are doing their scrutiny, to decide that a business is investable. So yes, anyone that wants it can just ask for it and they'll get it. Yes, sir.
Okay. And let us also say that you're based in Nigeria, aren't you? Can you give us an
Mm-hmm.
idea of what the VC market is like in Nigeria in comparison to, say, USA or UK, Europe, or Middle East?
Okay, so The thing is that these different regions, um, let's say in the United States, right? Venture capitalism has been there for decades already. So it's a very mature market, right? You see the
Yeah.
way it goes on in Silicon Valley, see the way people really easily get funded and then push out their product distribution. And it's somewhat not like that in Europe. It's a bit more there are a bit more regulations as regards investing in companies. If you look down to come down to markets like Africa, let's use Nigeria, for example. Venture capitalism is still in nascent stages. We're still quite early, right? And then we can't really compare the way it's run in Silicon Valley down here in Nigeria. And it's a mistake a lot of people have actually made. They see the way some startups easily get funded, the way they get checks, even when they've not proven so much, right? A lot of Nigerian founders tend to get this mentality. African founders, they want to like get it like that. And so they usually hit a roadblock. And that's because out down here in Africa, you need to have a lot of proof, right? Because they want to see that you have been able to build something before they can really invest, right? They are still trying to ensure that they are not making mistakes because the model is not the same thing. The way venture capitalism is operated in other parts of the world is not the same as operated in Africa. So I believe that the way it is going, a lot of African founders are going to first learn how to build properly before they really learn how to raise. And this is the gap that I saw that I'm looking to solve a lot because I see that when it comes to Africa, I put a post today talking about how I believe that startups are the future of Africa, right? But the only issue is that many of them are not investable. Founders are just looking to build businesses and then just start running after checks. And then they get a lot of no's. At the end of the day, they start getting what I call fundraising trauma. So fundraising trauma is when you have reached out to a lot of investors and you just get no, 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 no. And then you get tired of reaching out and
Yeah.
you just give up, right? Of either getting outside capital or you just shut down your startup, right? It happens to a lot of people. It's not really talked about out there, but a lot of founders I've talked to, they go through this, right? Because when they've gotten no, let's say up to 10 times, they're already scared of approaching the next investor that they are going to get
I
no. And
understand.
then it
Yeah.
reduces their confidence. Right. So it's not the same ball game. In America, it's easier to get checks and bigger amounts, right? And then you're allowed a larger playing ground. You see the way Y Combinator does their stuff, right? And other venture studios with also the way they just make it seem like you can just start something today and tomorrow you get $1 million check. When they see that there's a lot more opportunity than risk, they get to invest. And when they can believe in a founder, believe that the founder is grounded in reality, because most founders are not grounded in reality. They are living in the clouds. And so they don't know how to really de-risk their business. They just tend to say all the upsides. They never focus on, oh, what can happen when we get
Yeah.
capital? These are the things that can happen along the way. But when investors
Yeah.
can see that you are grounded in reality, they trust you. And when they can trust the founder, they're going to deploy capital.
Oh, that's great. Well, thank you very much for your work. Thank you for what you're doing. I must say you're doing really well on LinkedIn. You've got 16,000 followers. So there's a lot of disciples
Mhm.
who I'm sure will be following you and taking your advice. So thank you for what you're
Mhm.
doing. Okay, so we'll talk again another time.
Bye.